Hey, you win.
Really? Hey, why do I win?
When you were born, your parents gave you a social security number, at least signed up for you to have a social security number. And that means that every banker across America can now watch your every move when it comes to your financial decisions.
Always watching.
And that tracking of those financial decisions gives you a credit score. I mean, just look at Boss Baby. That right there. How's that kid gonna get a rollie? Come on. Yeah, it must be nice to have an 850 credit score right out the womb. Hey there, my name is Mike. Welcome to the channel. On this channel, I try to document my financial journey and hopefully give you tidbits along the way that you can do as well in your own personal finance journey. All right, guys, today we're talking about credit. What is it? Where did it come from? How do I use it? Why does some evil guy in a suit think that he can judge me anytime I go to the bank?
You think you can judge me?
Credit is, according to Oxford Languages, which is whatever Google uses,
I know some of these words.
is defined as the ability of a customer to obtain goods or services on the trust that payment will be made in the future. It's kind of like a bar tab.
Barkeep, I'm gonna need these 2 glasses and that bottle of whiskey.
Right? You tell the bartender, hey, open up a tab in order that I have this credit card. And then the bar tab will be paid in the future after you've racked up all the charges. Now, usually the credit system is going to utilize larger sums of money. And it's not as simple as like, hey, just charge this card later. And you're usually having to give up either your ID or your credit card or whatever that they keep on hold as collateral so that you come back later in order to settle your debts. Okay, now that's a small form of credit in which they don't actually like check your credit score to make sure that you can pay whatever it is that you're saying that you're going to pay. But in the event that you don't pay or don't settle your debt, they take whatever collateral that they have and hold it until you're able to pay or settle those debts. Now here, the credit that we're talking about is an individual score that will be used across everybody to determine how trustworthy you are in payment for payment in the future. The credit that we have as far as a generalized society is to allow for lenders to be able to check your personal score to determine how trustworthy you are for payment in the future. So where did this payment system come from? It's actually quite new. In 1956, engineer Bill Fair teamed up with mathematician Earl Isaac to create Fair, Isaac & Company to create the standardized objective credit scoring system. In theory, a standardized rubric would eliminate the prejudice inherent in the credit evaluation and lending practices used for many years. Today, Fair, Isaac & Company uses a different name called FICO. Fast forward a little bit into 1970, and credit was being widespread and utilized in more facets and across more different industries that would cause a concern for the accuracy and the standardization of reporting on what would actually be utilized. In 1970, the Fair Credit Reporting Act was instantiated by the US government to regulate credit bureaus and establishing rules for collecting and reporting credit information. This was also providing the ability for customers to dispute and have the right to assess and then dispute those credit reports. So we wouldn't have anything behind closed doors. You'd be able to look at it yourself and be able to dispute whether or not those credit items were legitimate or not. The current FICO system premiered in 1989 and has become the standardized practice used across most industries. This score is arranged from 300 to 850 and is determined by the following factors. I'm going to present these in descending level of importance. We have payment history, amounts owed, the length of credit history, credit mix, and a recent credit inquiries or new credit. So everything from bankruptcies to late payments factors into your credit score. There are tweaks and adjustments into the FICO's credit score all the time. Just as recently as 2016, there is a new FICO score 9 that minimizes the effects of medical debt as it's not weighted as heavily as other debt. And then also any collection amounts that have actually been paid in full will not be utilized in calculating into your score. Okay, so there's today's credit system's history. In this video, we want to poke into how that FICO score system is calculated so that we can try and get the best score possible. Better scores means better rates, so that when you're borrowing money, you're not having to pay as much interest to actually access that money. This becomes very useful when trying to buy a house or a car. But we need to be very careful on when and how we utilize credit, because we don't want to get into a situation where we have too many payments for how much budget we actually have to utilize. But even when we make those big ticket purchases or anything that utilizes credit, we want to try and pay it off as fast as possible in order to free up our money to use for more and more things. Okay, so as I said before, the FICO system is calculated off of these 5 factors: payment history, amounts owed, length of credit history, the credit mix, and recent credit inquiries. You need to be aware of those different factors to understand why your score is scored the way it is. Okay, so let's first talk about payment history. This is pretty obvious. Don't miss payments. If there is a minimum payment on a credit line of credit, you need to make sure that you're paying that in your monthly expenses. If you just don't make payments, your score will suffer, which causes new lines of credit to be able to move into new opportunities to not be available. Each account that you have, if you put a balance against whatever account that is, will have a minimum payment that is necessary. So just switching between cards to try and pass the credit around is not going to work. You eventually will need to pay on every single account that you have, as long as you have utilized it for some purchase. This means that you need to regularly monitor every single one of your accounts and ensure that a payment is paid if necessary on that account. All right, so next is the amount owed. This is derived off of your total credit and needs to keep under a threshold of 30% utilization. Now, what does this actually mean? It means that if you utilize your credit in any sort of way, that credit increase of utilization will cause your score to dip. But if it goes above 30%, that means that you have lost the standard credit score and are starting to negatively affect your credit. This means if you have a $1,000 limit on one of your cards, you need to make sure that you aren't utilizing more than $300 at any given moment while having that card. This doesn't mean that you can't just utilize that credit in case of an emergency or something along those lines, but you need to try and make sure that you don't have a running balance over $300. Do realize that this calculation of 30% is on a per account basis and across all of your other accounts as a whole. Next is your length of credit history. This is the one perk that is around for growing old. If you have handled credit for longer, the bankers will trust you more. That doesn't help your shriveled up skin, but it's something to say. There is a positive to getting old. There's not too much more to expand on credit history, so let's move on into credit mix. This one is a little bit interesting. There are typically 3 types of credit. These are revolving credit, installment credit, or open credit. And typically there's only 2 credits that a typical person will have, and that's the revolving credit and the installment credit. Open credit is kind of a dangerous utilization that many people don't utilize. Okay, so what are these? So revolving credit is your typical credit card. This is a credit that has a limit, but doesn't have any kind of structurized plan. You just have to pay it back over time while never allowing your amount that you're utilizing to go over your limit. The next type of credit is installment credit, and this would either be like a car or a house. This is a large form ticket item in which a actual amortization table of how fast you will pay off and how much is going to principal and how much is going to interest for every single payment that you do on the life of this credit line. You get to see every single payment and exactly what amounts are going to where every single time you make a payment. And then the final type of credit is open credit. Just for a tidbit, that last one, open credit, is just a line that is open that has to be paid off every month in full, no questions asked. And this is a type of credit that usually not too many people have. Creditors are usually looking for a mix between revolving credit and installment credit. This helps improve your score. The last piece of your score is recent credit inquiries. Anytime you make a hard inquiry into your credit, meaning you're trying to open a line of credit, this will actually hurt your score for an extended period of time or for a short period of time after that line of credit is open. This is why usually when you're buying a house, they will tell you to not go buy a big purchase. Don't hurt your credit in any way, because when they go to actually make the installment credit, they're going to have to hit your credit with a hard inquiry, and that could have negatively affect your rate that you're getting on your interest. Now, there is something called a soft credit inquiry, in which there are different pools of credit that will be forgiven against your score in a short time period, usually about a month or two, that would allow for you to show that you are shopping around to find the best interest rate offered by different lenders. This happens when you're buying a house or maybe buying a car, that you could ask for different lenders to try and find the best rate based on your credit score. Those small inquiries of your credit score are forgiven because you were shopping around for the best lender. But if you open a line of credit at a store and then another store and then another store, et cetera, those actual open lines of credit will hurt your score in the near future. And basically, this just means that bankers are worried that you won't be able to handle all of this responsibility because you're opening so many lines of credit so rapidly. After showing that you can handle these lines of credit, then your score will slowly go back up. Okay, so there's your understanding of what credit is and where it's coming from. But now we need to know how to utilize it. This is how I personally undertake this, and the reason that I'm utilizing the way that I do. I'm not saying that you should, or in any way dictating how things should be done, but just understand that credit is utilized for big opportunity payments. We shouldn't be swiping our credit cards at every single transaction known to mankind. That's a good way to get ourselves into astronomically bad debt. Now, I understand the argument that there are points or cash back or however you want to express that. But if you are using your credit card more than how much you are bringing in, then you have to stop that immediately. I respect my revolving credit as an open credit. The second the bill comes in, I'm going to pay it off completely. This allows for me to get that cash back and actually get some money back while never accruing interest. Interest is going to cause you to have to pay more on what you borrow, and that's throwing money away in which you don't need to utilize. And this brings me to the idea of what we're talking about when we're talking about needing to improve our score or why we want to improve our score. It always boils down to, why do you want to utilize credit? What is it that you're trying to do that will make you use credit? If it's day-to-day purchases, that's a silly excuse on why you want to have credit. If you have a need or a want, such as a car or a house, this is understandable in raising your credit in order to get the best rate possible. But if we're just wanting to utilize credit for like getting cash back, it is not a smart move to open new lines of credit for that particular purpose. Me personally, when I go and have my credit card that I get cash back on, I make sure to use it as like an open line of credit and pay off the bill immediately. The reason that I do that is to ensure that I don't accrue any interest on those credit cards. And this means that when I'm utilizing credit, I ensure that I already can pay back what it is that I'm spending. This means that if I had a debit card and a credit card, I could swipe either and it would function just fine. The thing that I'm doing is utilizing the credit card to get my small cash back, but the second that bill hits, pay it off. Done. Anyway, this just means that this average Joe is trying to pay off all his credit cards every single month and pay off his mortgage as fast as possible. This does mean that my score is pretty high. It doesn't mean that it's something that I'm like super proud of or something that I'm trying to utilize effectively. And I've never put too much focus on raising it in general because I don't think that it really means anything to a status symbol. As long as I don't utilize credit too often, everything pretty much just takes care of itself. Anyway, thanks for watching the video. I hope you learned something. If you did, think about hitting that subscribe button, maybe the like button. It always helps out the channel. I do appreciate it. Maybe you just want to come around and see my pretty face again. Anyway, have a wonderful day. I will catch you guys in the next video.